Hello. Right. Good afternoon, everyone. Today's topic: recent amendment, income tax return filing. We have Mahendra Bhai with us. I'd just like to introduce himself. He's a practicing chartered accountant of Mumbai. Is a partner in the firm Sanghvi and Sanghvi. He was a past president of Chamber of Tax Consultants, the chairman of Law and Representation Committee of Chamber of Tax Consultants. He was nominated as a member of Regional Direct Tax Advisory Committee by CBDT. Was a member of Standing Committee on TDS for Mumbai Region Commissioner of Income Tax TDS. He was a co-opted member of Direct Tax Committee of WRC of ICAI, the member of Direct Tax Committee of Indian Merchant Chamber, has written papers and given lectures in various meetings organized by Chamber of Tax Consultants, Bombay Chartered Accountants Society, Institute of Chartered Accountants of India and other organizations. He has written articles in newspaper and magazines of professional interest. He was a contributor to reference manual of WRC of ICAI. He has given various lectures during training sessions of public sector companies and orientation and training program of tribunal members. So here I will just like Ashok Mehta to present the memento to Mahendra.
Thank you. Thank you, Ashok Bhai. Thank you, Viraj Bhai, for your kind words, introduction. Friends, the topic that we will be discussing today, income tax amendments related to pertaining to assessment year 17-18, the effects thereon which we have been right now, which we have to use it. The effects are coming on account of various changes, amendments, notifications, circulars, and even I would say now not to stop over there, even the press, not press release, but by way of, you can say, a press publication or a news item. And the presentation, friends, I have considered the amendments which have been made on account of Finance Act 2016, Finance Act 2017, and amendment which has come after demonetization on 15th December 16, Wide Taxation Laws Second Amendment 2016, and relevant rules related to the preparation of income tax returns. Those all amendments I have considered in the presentation now. And unless I specifically mention the amendments which are carried out by Finance Act 16, it will be presumed that these amendments are by Finance Act 16. So in the presentation, wherever nothing is mentioned, it is to be understood that the amendments are by way of Finance Act 16. And the specific amendments pertaining to specific industries, I have not considered, like for finance industry or bank industry, startups, etc. Now let us start with our presentation. The first is, I would say, the warming up little bit, and which is related to the taxation, the rates of the changes of taxes. There is as such no change in tax rates and basic limits. In case of domestic companies whose total turnover or gross receipt in the previous year 14-15 does not exceed 5 crore, that will be taxed at the rate of 29%. And which you all know, friends, that for the from the subsequent year, that is for the next year, the amendment which is come by way of Finance Act 17, there it has been 15, the 29% has reduced to 25%, and where the turnover exceeds, instead of 5 crores, 50 crores. The next one is surcharge on income tax. Surcharge has been increased in case of individual HUF, AOPs, BOIs, wherein if the total income is less than 1 crore, it is nil. If the total income exceeds 1 crore, it is 15%. And of course, for the financial year, assessment year 18-19, the surcharge, there one more slab has been introduced, and that is where the income is between 50 lakhs and 1 crore, the surcharge will be levied at the rate of 10%. As far as rebate under section 87A for resident individual goes, the total income, if it does not exceed 5 lakh, the quantum of rebate is 100% of income tax, or rupees 5,000, whichever is lower. Earlier, this 5,000 limit was restricted to 2,000. And of course, in the subsequent year, that is for assessment year, which right now today we are not concerned, but for our advanced tax purpose, one can just take care about it and note it down. That for assessment year 18-19, this 5,000 has again been reduced to 2,500, and where the income does not exceed 3,50,000 instead of the 5 lakh which we had earlier. This there is some slide issue. It's not being dropped down. I would request the technician if would come and just help me out. All right. Every time I have to do this? No, nothing to do. Yeah. All right. Now coming to specific provisions, start with section 17, that is on the perquisite. Employer's contribution to an approved superannuation fund in excess of 1 lakh, the limit has been increased from 1 lakh to 1.5 lakh, and the excess will be now taxable as a perquisite. Section 24B, which is on deduction of interest from self-occupied house property. Second proviso, which we already have, there we all are aware the monetary ceiling of rupees 2 lakh is applicable, and it is available if the capital has been borrowed for acquisition or construction and which is completed within 5 years subject to other conditions. Earlier we had that if the property on which the loan has been borrowed, that construction work should get completed within 3 years, that 3 years have been increased to 5 years. And now in case if we do not complete within 5 years, then the again same old limit of rupees 30,000 deduction will only be available. That is as per the proviso 1. That brings us to section 28(5)(a), which says that the scope of income has been increased, and wherein non-compete fees received or receivable in relation to not carrying out any business or profession. Earlier this was restricted only to not carrying out any business. Now it has been increased to not carrying out any profession also. The profession has been inserted. Section 32AC, investment allowance. Cost of new plant and machinery acquired by a company in a previous year should be more than 25 crore. Second, these two conditions, first two conditions remains the same. Second one talks about installation of above plant and machinery should be completed on or before March 31st, 2017. But this deduction was allowable. There was some anomaly if in year 1 the plant and machinery has been acquired, but the installation has been completed in year 2. In which year would the deduction be allowable? That was the anomaly. Now here they have clarified that the installation of new plant and machinery is in a year other than the year of acquisition, then deduction will be allowed in the year in which the installation is complete, and that will be the year for 32 AC wherein can be claimed. 36(1)(7)(a). We all are aware that the provision for bad and doubtful debts in the case of banking companies and financial institutions of 5% of that provision was allowable under section 36(1)(7)(a). That has been extended to NBFCs also. Now NBFCs also will be eligible to come in aligned with the RBI provision norms. Section 40A IB. We all are already hit by section 40A 1A, so I did not explain, just to give an idea about what is 40A 1A is that in case if the taxes wherein tax was required to be deducted, but the same has been deducted and not paid, or the same has not been deducted, 30% of that expense will not be allowed if the taxes have not been deposited or the taxes have not been deducted. Now on the same lines, with effect from 1st June 16, any consideration paid or payable to a non-resident for a specified service on which equalization levy is applicable, the same will be disallowed. However, if the same in line with section 40A 1A, however, if the same has been deposited on or before the submission of the return of income under section 139(1), then the same will be allowed as an expense. Here let me clarify, friends, that there is no proviso added which we have that however the same will be allowable in the year in which it is deposited, that is in the subsequent year. So to that extent we are going to be hit that in case if it is not deposited before the due date of the filing of the return of income, then that deduction will not be allowed. Coming to section 43B. Deductions to be only on actual payment. All are aware that the payments for sales tax or for the taxes, fees, interest to the CC account, term loan account, if those are not paid on actual payment, only a provision is made. In that case, those expenses are not allowable. There is one more addition to that list, and which is now if the SSC has not made the payment to Indian Railways for the use of railway assets, that amount will not be allowed as a deduction. Coming to section 44AB. Here the limits which were earlier 25 lakhs for the professional, if the gross receipts of a professional did not exceed 25 lakhs, then if it exceeds 25 lakhs, he was required to get his accounts audited for the assessment year 17-18. That limit of 25 lakhs has been increased to 50 lakhs. Similarly, the limit of 1 crore for the businessman, that is the turnover or gross receipts of the business, if it exceeds 1 crore, that has been increased to 2 crore, that is for assessment year 17-18, the limit of 2 crores will be applicable. That has been introduced by way of a proviso. Therefore, if a person who is not covered under section 44AD, let us take an example of a commission agent. A commission agent whose turnover is 1.5 crore and who is otherwise not an specified SSC under section 44 AD, so he does not qualify for 44 AD. But if his turnover is more than 1 crore, he is required to get his accounts audited. So to sum up, we can say that only in case of an SSE who is otherwise covered under 44 AD and his turnover is less than 2 crore, he does not require to get his accounts audited under section 44 AD. 44 ADA, this is a new section which has been introduced for the professionals. Like we have a presumptive basis for which we all are aware for business, and in that case the section 44 AD is applicable to them. We have new section, that is 44 ADA, and which says that an SSE who is a resident and is engaged in a profession referred to in section 44 AA subsection 1, those persons are covered in 44 ADA only. Now, what happens to a person who is not covered in Rule 6F, which refers where the section 44 AA refers to Rule 6F? The list of professionals are already given. Now, what happens to those persons who are not appearing in the list? Say, for example, an astrologer, an event manager, a jewelry designer, etc. There could be many. In that case, that professional person would not be covered for 44 ADA. However, if his turnover, so he would be covered by the regular provisions, and if his turnover exceeds rupees 50 lakhs, in that case he would be hit by the provisions of 44 AB to get his accounts audited. The next one is gross receipts of the SSE from the profession does not exceed 50 lakh. So the gross receipts from the profession should not exceed 50 lakhs. Income of the SSE shall be calculated on estimated basis at the rate of 50% of the total gross receipts. Like how we have 8% for the business, now here we have 50% for the professionals. So we all professionals who are there, whose turnover is less than 50 lakhs, in that case, if you do not want to go for your regular, I would say, provisions, then you need to offer 50% and take the benefit of this presumptive basis. Now, is it a real benefit or not? We all have a question mark. Deductions under section 32, 38 shall be deemed to have been allowed. So mainly we can understand that yes, the depreciation would have been deemed to be allowed. So the year on year the WDV of that assets needs to be calculated. Now, if the profit is less than 50%, that SSE would have to maintain the books of accounts, and compulsorily he would have to undergo the audit as per the provisions of section 44 AB. However, one more mention I would like to say here is that the audit and the if an SSE whose total income doesn't exceed the maximum marginal limit, that is, say, if it's an individual and his receipts are less than 50 lakhs, if his turnover, if his profit is also less than 50% of the total receipts, say an example, if the gross receipts are 25 lakhs, the profit is say 2 lakhs, which is definitely much lower than the 50%. However, if his other income, including other incomes, if he is not required to, if his total income is still less than 2.5 lakh in the case of an individual, in that case it does not exceed the maximum marginal tax rates. Therefore, he does not require to get his accounts audited, and he does not require to maintain the books of account. 44 AD. this section has replaced two subsections, that is subsection 4 and 5. The proviso which was there originally has been deleted. Let us see the effect and the impact of that. We may have to give some time on this particular amendment. Let us run through. First two bullets are the old provisions, that is, income is deemed to be 8% of turnover or gross receipts. Second one, all deductions under section 30 to 38 are deemed to have been allowed. The limit, which was 1 crore, has been increased to 2 crore, which we also saw it in the earlier slide when we referred to section 44AB. The next one is no deduction or for interest and remuneration to partners will be allowed separately. Earlier, friends, there was a proviso by way of proviso 2, which said that after the profit, that is say 8% of the turnover, interest and remuneration will be further allowed from that profit. Therefore, let us take an example to understand. If the turnover was 1 crore and he has offered 8%, which say it comes to 8 lakh of rupee, and from that 8 lakhs, the interest to partners and remuneration to partners subject to the limits prescribed in 40B would be allowed from that 8 lakh of rupees. That proviso has been deleted. Therefore, now from assessment year 17-18 onwards, in the example that we have just discussed, the SSC would have to offer 8 lakh of rupee if the turnover is 1 crore. Or else he will have to get his accounts audited. Now, it doesn't stop here only. Number one, the effect of this is, let us understand first subsection 2 and subsection 5, which have been replaced, which says once claimed, that is SSC has to declare, the SSC has to, once he has opted for this presumptive basis, he has to declare for consecutive 5 years, and that is, he has to offer his 8% income for the consecutive 5 years, subject to, of course, that his turnover does not exceed 2 crore. And if he opts out in any of the 5 years, he will have to maintain the books of accounts and get them audited. Of course, subject to the basic exemption for subsequent 5 years. And he will have to continue this for, so if he's opting out, then for the subsequent 5 years, he will not be able to opt for this presumptive section. So let us understand by way of an example. An SSC for the assessment year, in the next slide we have taken that. An SSC for assessment year 17-18 has availed the benefit, I would say, rather right now I'll say has availed the benefit of 44AD. So in that case, the SSC has to offer under the same for the next 5 years, that is 18, 19 to 22, 23. If in any of the subsequent 5 years, not disclosing income as per the provisions of 44AD, say for subsequent year, say assessment year 18-19, the SSC is not able to offer 8%. There is a genuine loss which can be explained. Then in that case, he opts out of the presumptive income. Then from assessment year 19-20 to assessment year 24-25, he will not be eligible to claim benefit of the presumptive scheme. And since he is not able to take the benefit of the presumptive scheme, he will have to pay the tax, he will have to maintain the books of accounts, and he will also have to undergo the audit. the effect of this amendment would be, if I need to have a plain reading, then first of all, for the assessment year 18-19, when his income is below 8 lakh, that is the first year when his income is below 8%, he does not require to get his accounts audited. On the contrary, for the subsequent 5 years, even if his income is exceeding 8%, he has offered more than 8%, still he will not be able to take the benefit of 44 AD. He will have to get his accounts audited. The main purpose when this proviso, when this section was introduced, at that time, the reason given was the small SSEs who are otherwise not, if they offer the income of 8%, in that case, they need not maintain the day-to-day books of accounts, the records, and on the presumptive basis that 8% will be accepted by the department. Is this a beneficial provision anymore? The question to that, if I have a question that is it a beneficial provision, the answer to that we all will say that no, no more. To my surprise, when one of the senior brought to my notice that the intention is to give a benefit to the small taxpayers, in turn, after this amendment, the intention has been lost and it has worked reverse. Now, how it has worked reverse? First of all, let us take an example of a partnership firm. A partnership firm, after the removal of the proviso that we just saw in the earlier slide, there wherein no deduction or interest and remuneration to partners will be allowed separately. After removal of this proviso, if the interest and remuneration is allowed, for sure the interest, the profit of the firm will reduce to 8%. So if it is reduced to 8%, he cannot opt for this benefit. So therefore, a small SSE will not be, a small partnership firm cannot take the benefit of this section anymore. Secondly, in case of an individual in the year 1, as we have seen in this example, in the year 1, 17-18, he has taken the benefit, he has offered 8%. In the year 2, for a genuine reason, there is a loss and he is opted, he needs to opt out. For the subsequent 5 years, he cannot again come in. So a small SSE, even in the assessment years 19-20 to 24-25, if his turnover is say 1 crore rupees, he will not be able to take the benefit of this. On the contrary, he will have to get his accounts audited, which otherwise he is not required to get his accounts audited because of the provisions of 44 AB. So we can say that yes, the entire purpose of this section is lost because of this amendment, and I hope the legislature now rethink on these issues and consider that whether this provision again requires to be looked into by again reintroducing the proviso which has been deleted, and second, this 5 years not to get his accounts audited, or to get his accounts audited and he cannot opt for. I see no reason or what is the purpose behind this. I still could not find out from the memorandum also. Thereafter, there are a few more amendments pertaining to 44 AD, wherein it is said that advance tax will have to be paid by 15th of March. And I understand that yes, the reason is earlier the limit was 1 crore. Now the limit has been extended to 2 crores. So therefore the profit also would be higher. And since there is a higher profit which has been offered, the department thought the finance minister thought that yes, they should also pay advance tax. Therefore, they have only the fourth installment is required to be paid. That is, by 15th of March, the advance tax would be required to be paid. If that is not paid, then we need to. I understand already the date is gone. That is 15 March 17. The SSC was required to pay. Now, if that date is, if they have not paid, in such a case, one needs to calculate interest under Section 234B and thereafter make the tax payments before filing the return of income. Further, the finance minister, by way, if you all are aware that Prime Minister Modi ji, he is very much into digitalization. The payments should be, as far as possible, the payment should be digital transactions. To promote that, one more amendment, which is by way of Finance Act 2017, but it has a retrospective effect, that is from assessment year 17-18, and which says that the deemed income shall be calculated at the rate of 6% and not 8%, which we have it in our regular provisions, if the following two conditions are satisfied. One, the turnover or the gross receipt is received by an account paid check or draft or use of electronic clearing system. Second, the above payment is received during the previous year on or before the due date of submission of the return of income. Therefore, if the SSE has received the payment otherwise than by cash for his sales or realizations, then he can offer income at the rate of 6%. This is some promotion that he has given. So I look at it as an incentive provision. Now, if it's an incentive provision, the 6% has been the 8% has been replaced by 6%. So the incentive that the income would be reduced by 2%. If the income goes to reduce by 2%, can a person still continue to disclose 8% and pay tax at the by way of 6%? There is some anomaly, which there are two views possible. One view says that no, since you are offering income at the rate of 6%, you can capitalize 6% and not 8%. The other view, which I would also support, is that since it's an incentive provision, thus 8% is reduced to 6%. Otherwise, there would not be any difference between a person who is receiving cash, if he is also going to pay 8%, and if the other person who is not receiving cash, he is also going to capitalize only 8%, then there would not be any distinction between that person if he is supposed to consider 8% for his income. Coming to another provision, section 2, that is 42A, wherein the definition of short-term capital asset has been amended for a particular category, and which is share of a company not being a share listed on a recognized stock exchange in India. If it is held for more than 24 months, then it is long-term capital asset. Instead of 36 months, which it was earlier, now it has been changed to 24 months. So now the status of this further definition of short-term capital asset will be listed shares, units of UTI, equity-oriented mutual funds, etc., 12 months period. Unlisted shares, 24 months period, and other assets, it is 36 months period. And for assessment year 18-19, we all know that the Finance Act 2017, the 24 months have been also, the category of immovable property is also included for 24 months. That is a property wherein which is holded for more than 24 months. In that case, that asset will become a long-term capital asset. Coming to an amendment made in section 49 subsection 5. Here this is on account, it's not an amendment, it's an insertion of this subsection 5. This is on account of Income Declaration Scheme 2016, which says that capital gain arising from transfer of an asset which is declared under Income Declaration Scheme and whose tax, surcharge and penalty has been paid in accordance with the provisions of the above scheme, then cost of acquisition of such asset shall be deemed to be the fair market value of the asset as on 1st June 16. That is the first day of the commencement of this scheme. So the cost of acquisition has been already decided that on whatever cost you have offered, or the value, the fair market value if you have offered for IDS, that will be the cost of acquisition. There is no dispute on that cost. Clause 2 to explanation 1 of this section empowers board to make rules for determining the period for which the capital asset is held by assessee. This provision is already there in section 49, in section 2 subsection 42A. Now the board has exercised this power by way of a notification dated 6th October 16, wherein they have inserted subrule 3 to 8AA, and with it is with retrospective effect from 1st June 16 for determination of period of holding for capital assets declared under Income Declaration Scheme. So this rule will apply from the very first day of the scheme, and which says that in case of immovable property, the period shall be reckoned from the date on which such property is acquired if the date of acquisition is evidenced by a registered deed with any authority. Second, it says in any other case, the period for which such asset is held shall be reckoned from 1st June 2016. So the holding period, the first day of the holding period in case of IDS declared assets will start from 1st June 16. Now what happens to an assessee who has already sold who has declared an asset under IDS and sold the asset on 5th of October, that is before the notification of this date. And in the IDS he has already declared this asset that it was pertaining to say example, it was pertaining to assessment year 2013-14. And he has an evidence to show that it was acquired in the relevant assessment year of 13-14. He had a demat account which was opened in the financial year 12-13 and which has been offered, those shares have been offered at a market value prevailing on 1st June 2016. But those shares were sold on say 30th of September. The holding period of that, as per this rule, which has, or the notification which has come on 6th of October, says that you need to apply the date as 1st June. But the assessee at that date did not have this notification in hand. Sorry. Whether in that case also the assessee will have to calculate the date of acquisition as 1st June 2016. If I have to see this notification, answer to that is yes. but that can be a gray area and the disputes would be there, because whether a rule can be applied which is not in favor of an SSC from retrospective effect. And the second question comes that if it's an immovable property, they have taken the date as the date when it was registered. That means there was an independent government or an authority, so there are no chances of any dispute that what was the date of an acquisition. On the similar lines, if a demat account is there or any other asset is there wherein there cannot be any dispute regarding the date of acquisition, why even those assets could not have been covered is a big question mark. They should have either made this clarification in the scheme itself, so that the people are aware about these schemes and all the small intricacies which should not have come later on and which is against the SSC. The next amendment brings me to section 50C, which is in nothing but in line with section 43CA, where the date of agreement fixing the value of consideration and the date of registration, if they are not the same, the stamp duty value may be taken as on the date of agreement, that is in the year 1 when the agreement is done. But however, the same property is registered in year 2, then the year 1, whatever the value was prevailing for the stamp duty purpose, that value will be considered as the value for the purpose of section 50C. Only issue may arise is that whether this can be read retrospectively, whether it would be treated as a clarificatory nature. There are tribunal decisions which has said that yes, this can be read retrospectively. Coming to section 54EE. This is an incentive provision. This is an exemption if investment is made in units of specified funds, like how we have specified bonds, that is for 54EC. Same way here we have specified fund, and those funds are mainly which are set up for startup companies, and they can also have the benefit. The SSC can have the benefit, but it has been brought to my notice that till date there is no notification or the fund which has been formed wherein the SSC would be able to take the benefit of this, because here also he was supposed to make an investment within 6 months from the date of transfer. Now, if a person has already sold those sold an asset, then how is he going to acquire the units of the specified funds when they have not been still notified? But for the purpose of section 54EC, when those bonds were not made available to the public, the 6 months period had passed. Thereafter, the SSC had purchased those bonds. In that case, the tribunal has taken a view that the period when the bonds were not available, that period should be excluded for the purpose of the 6 months calculations. So one can take a benefit of that whenever these units are notified. Section 112(1)(c), tax on long-term capital gain in case of a non-resident. Here, long-term capital gain which arises from transfer of capital asset, being shares in a company, not being a company in which public are substantially interested, that is a closely held company, shall be charged to tax at the rate of 10%. Therefore, the option of the 20%, 10% that is without indexation and 20% with indexation is now available to a non-resident also, but it is in the same lines like how we have it for our shares of listed companies sold without STT. With STT, I'm so sorry. Assessment here, section 80 EE, interest on loan taken for residential house property. Now this section, if you see, it would be really workable also or not, because the amount of deduction and the conditions laid down, if we just run through very fast, we will see that either very few SSCs will be able to take the benefit, or really it's just to show that yes, some incentive is provided in this Finance Act, which says that deduction is available in respect of interest payable on housing loan or rupees 50,000, whichever is less. And deduction is available for assessment year 17, 18 and subsequent assessment years, subject to the following conditions. One, assessee is an individual. Loan is taken for acquisition of a residential house property. Applies to loans which are sanctioned between the period 1/4/16 to 31st March 17. And loan should not be more than 35 lakhs. So therefore, a residential house where the loan amount should not be more than 35 lakhs and within the period 1/4/16 to 31st March 17. And the value of that residential house property should not exceed 50 lakhs. Then this deduction will be allowed, and this deduction is over and above deduction claimed under section 24B, but no double deduction. Therefore, if a person, if he fulfills this condition, first three conditions, first definitely he will be taking the benefit to the extent of the 2 lakh rupees available. In case if that 2 lakh rupees is not, if the interest paid is more than 2 lakh rupees, say it is 2,50,000, then first 2 lakhs he will adjust under 24B, and thereafter this 50,000 will be available under section 80EE. However, if it is only 2 lakh rupees, then one cannot say that yes, 2 lakh rupees I am going to claim. If it is only say 50,000 rupees, then one cannot take the benefit that look, first I am going to take the benefit of this 50,000 in 24B, and thereafter even under section 80EE. So to that extent, I would say only very few SSA will be able to take the benefit, if at all they have a loan sanction between this period. The next one brings me to 80JAA, that is deduction in respect of employment of new employees. This, yes, it's a good provision. It's to generate the employment, where the SSC, if he has genuinely generated the employment by employing new employees, in that case he will get an additional benefit of the 30% of the additional employee cost which is incurred in the previous year, and that will be available for 3 years, including the year of employment, subject to certain conditions, and one can just run through those conditions. I would not take up all those conditions, but in principle, I can say that yes, if a person has genuinely not replaced the old employees, but have given employment to new employees, then he will be able to take the benefit of this section 80JAA. Section 115 BBDA, tax on certain dividends from domestic companies, applies to a case of individual HUF or firm resident in India, where aggregate of dividends declared, distributed or paid by a domestic company exceeds rupees 10 lakhs. Tax will be, the SSC will have to pay tax at the rate of 10% of dividend in excess of the 10 lakhs. No deduction in respect of any expenditure or allowance will be allowed, and therefore the tax one will have to pay is the 10% of the dividend in excess of 10 lakhs. No set off of losses shall be allowed under any other provisions of this Act, and it does not apply to deemed dividend under section 222E. Simultaneously, there is an amendment to section 1034 also, which says provided that nothing in this clause shall apply to any income by way of dividend chargeable to tax in accordance with the provisions of section 115 BBDA. Now the effect of this is that if an SSC who is receiving 11 lakh rupees dividend, and presuming that to make an investment he has incurred and interest expense also. That interest expense will not be allowed because, yes, because earlier also we have a provision, section 14A, wherein it said that yes, if you have an income which is not included in your total income, so this dividend, which if it was less than 10 lakhs, it would not included in total income, the interest expense is not allowed. Here now, if an same SSE, he has received a dividend of 11 lakh rupees, but 1 lakh rupees now today is taxable to the extent of the 10%. Because of the provisions of 115BBA, this nothing will be allowed. So the interest, no interest will be allowed, not even the proportionate interest will be allowed out of this dividend income. Therefore, we can say that a dividend which is declared by a company or an income which is declared by a company, first the company pays tax, thereafter by way of dividend distribution tax, again the company pays tax, and thirdly now, so three levels, on the same income, the shareholder will be paying indirectly 3 times the taxes at different rates, and thereafter only the net amount he will be able to enjoy that. This is what the new provisions of 115BBA has come. I would like to take up over here a query which we have just received and which relates to the disclosure that requires to be made in case of a SSE, a dividend which has been, dividend income is there of an SSE, which includes dividend received from mutual funds also. Earlier, friends, in the return of income, if you see, there was only one item, that is dividend income, that is for the exempted income. The dividend income was shown separately, and under the dividend income, we were also including the dividend received from mutual funds. Now they have changed that field, and they have mentioned dividend income from domestic companies amount not exceeding 10 lakh rupees. We appreciate that, yes, the amount of 10 lakh rupees is rightly considered, but it talks about only domestic companies. Therefore, a dividend which is received from mutual fund, where are we supposed to disclose this? Are we supposed to disclose this under others, that is other exempt income, or can we include that in domestic dividend from domestic companies? Because these mutual funds are not a domestic companies. Therefore, I would suggest that it needs to be included in others, that the exempt income we do have an others column, and let us include that in others, mentioning that dividend received from mutual funds, the X amount. 115BA, income from certain domestic companies. We already seen earlier that the rates from 30% was reduced to 29%, and in the subsequent year it will be reduced thereby to 25%, subject to certain conditions and certain turnover of the company. Similarly, here also we have, for mainly for the startups, I would say this benefit is, but definitely available to a company which is set up and registered after 1st March 2016, which is engaged in the production or manufacturing of an article thereafter. So it's only basically the manufacturing companies, not the trading ones, and it should be the only business of this company, and the total income computed would not have the benefit of carry forward of losses and all. In that case, the taxes will be paid at the rate of 25%. This will be a beneficial provision. One can take a benefit of this rates. The other conditions are there, which one can just run through very rapidly, and it will be available in the presentation. 115 BBE. This provision, which was already there since assessment year 13-14, which was introduced by Finance Act 2012, but it was not. The heat of this provision was not felt. The heat of this provision is felt only after the demonetization. That is, after the amendment which has come. There has been amendment even after the Finance Act 12. There was an amendment in Finance Act 13. And right now we are concerned with the finance. What does this section say? Let us understand the background of this section. What does section say? This section says that the income which is on account of section 68, 69, 69A, B up to 69D, the income which is offered or which is in the total income, if it includes the income out of these sections, in that case, a separate tax, a special tax rates is to be applied, and which is at the rate of 30%. This is what has been introduced from finance assessment year 13-14. The reason was that in case if an assessee, if he has an income which is below the maximum marginal limit, say he has an income of 1 lakh, if an addition of another 2 lakhs is made, the income would come up to 3 lakhs. If he is an individual, he would get a benefit of 2.5 lakhs, and thereafter on that 50,000 rupees he would be paying tax at the rate of 10% only. So, and on an addition which is made under section 68 of rupees 2 lakhs, he would be paying a tax of only rupees 5,000 in the example that we are discussing. After this amendment, the tax of the 2 lakh rupees you are required to pay straight away 30%, that is 60,000 rupees tax you need to pay. That is what this amendment talks about. That is for assessment year 13-14. But by way of after demonetization, the Taxation Laws Second Amendment 2016, from 15th December this amendment is there, but which says that it works retrospectively, that is for assessment year 17-18 and onwards, where the total income of an assessee includes any income referred to in those specified sections, that is section 68 to 69D, and reflected in the return of income. Earlier, friends, we all have seen that never till assessment year 17-18, neither there was any provision in the return of income also to offer the income over under these specified sections, nor was the section was read in such a way that the assessee does not have an option to offer this income. It was the assessing officer who would treat certain credits or certain expenditures or investments under specified sections, and on the specified sections, the income which is the additions which are made, tax rate at the rate of 30% was to be applied. Now it says number 1, the assessee can so motu offer this income under this section, and even the return has been modified to that extent, and wherein section wise, separate section wise, you can make a disclosure for section 68, 69 to all these specified sections. That is number 1. The second, the B clause says that if the income which is not otherwise offered as in the specified section, the assessing officer can treat certain income or certain investments or an expenditure under the specified section, then the tax under A clause will be paid at the rate of 60%, and under B clause it would be increased further by 10%. Now this 60% this 60% should be further increased by 30% the 60% should be further increased by the surcharge and the education cess, which will come to 77.25% as against 30% which otherwise was there prior to assessment year 17-18. So for the assessment year 13-14 to assessment year 16-17, it was 30%. Now it will come to 77.25%. One needs to be very careful over here while verifying and preparing the return of income. Now this illustration will help us to understand what would be the impact of this even if an assessee has offered the income but not offered under the specified provision and the assessing officer has treated them as a specified sections and thereafter levied the taxes. Even if an assessee whose total income does not change, 60 lakhs remains 60 lakhs in both the examples if you see. However, he will be paying a higher tax in this and which will be further increased by a penalty under section 271 AAC at the rate of 10%. So the tax would come to 21.05 lakhs instead of 19.25 lakhs even when the income has already been offered under the return of income. Here the difficulty, friends, would arise is that the purpose of introducing by way of this second amendment which we saw, that is from 15 December, the Taxation Law second amendment, wherein we saw that many persons have deposited cash in the bank accounts, and that time the various persons, the professionals and other press also had given the view that if the amount of cash which has been deposited in the bank account, the cash which has been deposited in the bank account, if that is already offered and shown in the return of income, in that case the assessee will be paying tax at the rate of 30% only. And since here there will not be any income under assessed, therefore no penalty provisions, that is as per the new penalty provisions which we will just see after a few slides, that is under section 270 capital A, the provisions of 270 capital A will not be applicable, hence he will be paying a tax at the rate of 30% only. Probably because of that, this amendment has come by way of taxation laws amendment, and which is working retrospectively. Therefore, any cash deposited today, which we are required to consider for the filing of our return of income and preparing of our computation, if that income, if that source of the explanation, source of the deposit is not properly explained, you cannot explain it. In such a case, one needs to think whether he would fall under one of the specified sections and pay the taxes accordingly. Now here, the benefit of this 77.25% would be applicable only in case if a person has so moto offered in the return of income and has also paid the taxes before 31st in the relevant previous year, that is before 31st of March 17. Now in case if he has not paid that taxes, the penalty of 10% when we come to 271 AAC will be hit, because two conditions for the penalty of under section 271 AAC are to be complied with, and which says that the taxes are paid before the end of the previous year. Now the previous year has already ended, so one needs to check that if the taxes which are paid in the previous year, whether that tax is paid 77.25%. In that case, the penalty would be avoided. Otherwise, the 10% penalty will also be levied under Section 271 AAC. The problem will not only stop for the demonetized notes which has been deposited in the bank account. We all understand that yes, this amendment has come on account of this demonetized notes, but they have not restricted these additions to only demonetized notes deposited in the bank account. They have specified that any additions or any income which are covered in the specified sections will be hit by way of the provisions of Section 115 BBE, and therefore any additions made by way of your bogus purchase, which is very commonly found by way of bogus share capital or any loan which has not been accepted and treated as a cash credit, or any item which according to the assessing officer is an investment which has not been disclosed. All those cases one will be hit by 115 BBE, and there will be various litigations pending now on account of these conditions. They should have either restricted only for the demonetization notes and not further. Now we are even aware that what happens to the assurances that has been given by the officials. We are aware that yes, through various advertisements in the media, wherein the Prime Minister himself had said that the small businessmen, housewives, artists, labor, etc., if they have deposited cash up to rupees 2.5 lakh, then they will not ask any further questions. On 12/11, after the demonetization, a public announcement was made wherein the Honorable Prime Minister said that married women will not be subject to any sort of inquiries. But there is no circular thereafter till date that yes, whatever earlier was said of 2.5 lakhs will be added to. On the contrary, we have a specific disclosure to be made in the return of incomes, wherein if the deposits are more than rupees 2 lakhs in this period, then you are supposed to make a disclosure in your return of income. So therefore, instead of 2.5 lakhs, it is 2 lakhs which a disclosure is to be made. And the disclosure also not only of the demonetized amount is to be made, a disclosure. Sorry, that is for the purpose of our audit reports we have to consider. Therefore, a person, an assessee who has made a deposit, whether that is his income which is out of disclosed income, out of his past saving, out of his withdrawals made during the earlier period of the demonetized amount, or whatever it is, but an amount, whatever is deposited during this demonetized period, and if it is exceeding rupees 2 lakhs, that assessee will have to make a disclosure. This is a specific query also which has been raised by one of the member, and which I think I have answered to that. If still further questions are there on this particular issue, he can type it out, and after the my slide presentation is over, I will like to deal thereafter. I have already dealt with Section 271 AAC, which says that 10% of the amount will 10% will be further payable than what is paid under Section 115 BBE, and that would increase the limit. And the two conditions also which we have just discussed a few slides earlier. Certain conditions or certain note which I would like to bring to your notice is that no penalty under Section 270 capital A due to underreporting of income shall be imposed in respect of income on which penalty is levied under Section 271 AAC. So this is one severe, I must say that. However, a penalty under Section 271 AAB, which is on account of search, conducted under section 132 will operate simultaneously. Therefore, both these provisions can be applied simultaneously. Provisions of section 274, that is the procedure for levy of penalty, that is the time limit and all, will also apply in case of 271 AAC. And of course, it would be an appealable order. So one, if is agreed by the penalty, then one can file an appeal before the CIT appeals. Coming to the penalty provisions which has been introduced from assessment year 1780 under section 270 capital A. The earlier provisions of 271(1)(c) would not be applicable from assessment year 2017-80 and onwards. Now we have, if there is an underreporting, the tax payable would be 50% of the penalty payable will be 50% of the tax, and if it's a misreporting, it will be 200% of the tax payable. So one needs to be very, very careful while preparing their return of income, preparing their computation, and bringing this fact to the notice of the assessee that if you are underreporting the income, then you will have to pay penalty at the rate of 50%. And similarly, if you are misreporting also, intentionally also if you are doing it, it would be 200% of the tax payable. So one needs to be very, very careful that if a person is paying, if it's a tax slab of 30% plus surcharge, or plus, I would say, and plus education cess, which may come to 34% plus something, there, and if the 200% of the tax payable is there, it would almost be the 100% of the amount which one will have to forego if it falls under misreporting. Therefore, there is a therefore it becomes very important for us to see to it that the computation is properly looked into and thereafter fine. A small I just wanted to touch upon is the TCS provisions which are there. Yes, I understand that it has nothing to do with the filing of the return of income, except for that when we are taking a rebate, one needs to be careful that in case of TCS, say for example, a motor vehicle if you have purchased, the taxes have been deducted, the taxes have been collected by way of TCS, then don't forget to take the credit of that TCS amount before paying the self-assessment tax. Similarly, the TDS provisions, there have been changes, either the limits have been increased from old limits to the new limits that has been available in the slide. So apply accordingly and then make the disallowances if at all to be made under section 40A(1)(a). And similarly, if we have to report for tax audit reports, also be careful before making any reporting and making any disallowances that the threshold limits have been increased, and even the rates have been changed. Some certain places from 2% they have been reduced to 1%, and from 10% they have been reduced to 5%, and more applicable directly would be to the commission and the brokerage, that is under section 194H. The advance tax. There has been a change in the advance tax. The 4 installments which you are supposed to pay by way of, earlier which was only applicable for corporate assessees, that has been made applicable to non-corporate assessees as well. The June installment which was not there first, now that has been there from assessment year 17-18. So therefore, while preparing your computation of income, be careful of your calculation under section 234, interest under section 234C, that if there is any shortfall from the installment June onwards, the one needs to calculate 234C accordingly. Amendment by Finance Act 17, that is with effect from 1/4/17. An assessee who declares his professional income in accordance with presumptive taxation regime, that is 44 ADA, shall also be liable to pay advance tax in one installment that is on or before March 15. Earlier slide, friends, when we saw that a person who was for assessment year by way of Finance Act 2016, which we earlier saw that an amendment is there for section 211, which says that an assessee who is covered in 44 AD, he is required to pay advance tax on or before March 15. Therefore, a person who was covered under 44 ADA, that is the professionals, he was covered in a regular advance tax scheme, that is 112 4 installment he was supposed to pay, but by way of amendment in Finance Act 17, but which has been made applicable from assessment year 17-18 onwards, and which has said that for the professionals also who have opted for 44 ADA, he requires to pay only one installment and not the 4 installments. Therefore, while working our interest, one needs to be careful. Now coming to specific provisions for filing for the return of income. Section 139(1) has been amended to the extent that who is required to mandatorily file the return of income. Earlier, it was required that to an individual or an HUF, if the total income is crossing the basic exemption. Now it says that the total income without giving effect of long-term capital under section 1038. So before that, if his income is crossing the basic exemption, one needs to file the return of income mandatory. The second provision is 139 subsection 3. Loss of specified business under section 35 AD cannot be carried forward unless such return of loss is filed before the due date of the filing of return under section 139(1). And a consequent amendment to section 80 is also carried out for the loss of specified business under section 35 AD. The section one needs to be careful is 139(4). Any person who has not furnished a return within the time allowed under section 139(1) may furnish a return at any time before end of the relevant assessment year or before the completion of the assessment, whichever is earlier. So, person here, number one, he is now supposed to file the return of income at any time before the end of the relevant assessment year. So therefore, the 1 year period has been reduced. Return of income can be filed up for the assessment year 17-18. Now the return of income can be filed only up to 31st of March 18, and not, if you apply the earlier provision, it would have been 31st March 19. Therefore, one needs to be careful for the assessment year 17-18 and onwards. 139(5), wherein it says that return furnished under section 139(1) and 139(4) can be revised within 1 year from the end of the relevant assessment year. Therefore, number one, you will see that there are 2 amendments which have been carried out. Number one, first, now here the belated return can also be revised. So a return file under 139(4) can now also be revised under section 139(5). The second one, the return now can be revised only before the end of the relevant assessment year or before the completion of the assessment. So here also the return to be revised will be only up to 31st of March 18 and not thereafter. Under section 139(9), which earlier we saw that the return would be treated as defective if the self-assessment tax along with the interest which is payable is not payable as per the provisions of section 140 capital A on or before furnishing of the return of income. Now that will not be anymore. It will not be treated as a defective return. I was given to understand that even the return of income, if you are showing any amount payable and the asset tax has not been paid, then the return, you are not allowed to even upload the return of income. Now there should not be any issues. You will be allowed to upload the return of income, and either the return of income would not be treated as a defective return. Now let us come to certain key changes which are there in the income tax returns. That is what we commonly call ITR. Total number of ITR forms, which were 9, has been reduced from this assessment year, or I would say for this assessment year, to 7. Erstwhile ITR 2A, 2 and ITR 3 have been changed to the single return, that is ITR 2, and ITR 4, which was earlier, has been renumbered to ITR 3, and ITR 4S, that is Sugam, is now ITR 4. These are the key changes as far as the ITRs, applicability of ITRs are concerned. ITR 1 is applicable for individuals having income from salary, one house property, other sources, that is interest, etc., and having total income up to rupees 50 lakh and agriculture income below rupees 5,000. ITR 2 for individual and HFs not having a business or profession under any proprietorship. ITR 3 for individual HFs having income from business or profession, and that is the Sugam, that is we just now referred, which was 4A earlier, that is 4 now, for any presumed income from business or profession. And similarly, ITR 5, 6 and 7, which were there earlier, there is no change, those ITRs are applicable. There is some slow connection here, maybe the chargeability is there. Then you have, I have received notification, you have a slow connection. Would you like to hide the webcam? Slow connection is there. Maybe webcam is not working possibly, or should I make it no? It's working fine. Certain major changes we will just run through, which are there for our ITRs. Of Aadhaar number, that is for ITR 1, 2, 3, it has been mandatory. That mandatory is because of the amendment which has already been carried out as per the section 139AA, and which says that with effect from 1st of July 17, individual SSCs are required to quote Aadhaar number in ITRs except and that exceptions are coming out by way of a notification, which is from 11th of May. And those exceptions are a SSC residing, an individual residing in the states of Assam, Jammu and Kashmir and Meghalaya, a non-resident as per the Income Tax Act 1961, a person who is an individual who is in the age of 80 years or more, and an individual who is not a citizen of India. I understand there was a problem till last week, which has been solved now, that a citizen, a non-citizen of India, in that case also they were not allowed to upload unless the Aadhaar were linked. But now they have rectified that sigma, and now they are allowed to upload. So therefore, a person who does not have an Aadhaar, who is not otherwise a senior citizen or is not a non-resident, then he will have to either reside in the state of Assam and Jammu and Kashmir and thereafter file the return of income. Otherwise, he has to link his Aadhaar first, and then only he will be eligible to file the return of income. Other details includes the accountant, that is in the case of the audit which were there, audit reports, audited accounts were there, in their SSCs were required to give the registration number, the membership number of the person who has audited the accounts. Now, along with that, the registration number of the firm or the proprietary concern who has audited the accounts of that SSC are also required to be given. Then, bank details of bank accounts held outside India. That has been a major concern. And let me tell you, friends, that as I mentioned earlier when I started my lecture, that the amendments which have been, we are covering the amendments are carried out by way of NSX 16, 17, notifications, etc. But here we have no notification, we have no amendments to the disclosure of this particular field, where it talks about that bank details for bank accounts held outside India in the case of a non-resident. So what does the return require? Let us first understand what does the return require. It requires that a non-resident is required to give details of bank accounts held outside India. And what details it asks for is the IBAN, that is oblique or a SWIFT code, name of the bank, country of location, and the account number of that bank. Therefore, first of all, this change has come by way of a sigma change from 23rd of June 2017. So on that date, so we do not have any notification. Neither prior to that we have any notification. So the question comes, the question arises that is an SSC who is a non-resident mandatorily required to submit this information, or is it an option? Fortunately, I have been told that an SSC, this field is not a mandatory field. Therefore, an SSC who has not filled up this field, still his return is being uploaded. Therefore, the question that his return will not be uploaded does not arise as on date. Secondly, what happens if an SSC prior to this sigma has already filed the return of income, and when this disclosure is not there? Otherwise also it was not there that time, because the sigma has been introduced from 23rd of June. But if you download the return today after logging in of that SSC, the return will be in the new format. That is, the return will show that as if those field was appearing in the return which has been uploaded, which is incorrect. The return which was uploaded before 23rd of June did not have this field of disclosure in the case of a non-resident. But the same person, if he is downloading the return which has been uploaded by him from the website of the income tax after logging in that case, this field will appear and will appear as a blank, as if he has not made any disclosure. So to me, I don't think the SSC is required. Such a person who has filed the return before 23rd of June, he requires to do anything on this. Now the question comes, what about the person who is going to file the return of income today, or who has already filed the return of income in between 23rd till date? But if he has already filed, whether he is required to revise his return of income, or whether, and a person who is going to file, whether it is mandatory for him, or what happens if he does not disclose this? Will his return be treated as a defective return or an incomplete return? First of all, if you see, does the government has a jurisdiction to charge even an interest earned on those savings accounts, or an income which has accrued or arisen outside India? The amount of that income has been deposited in such savings account. Can that be made taxable? Answer to that is no. Then what is the purpose of asking this details? Maybe for the transparency, maybe for the purpose of completion. But however, there cannot be any income. If there is an income which is otherwise taxable, even if he is a non-resident, and if the income is otherwise taxable, and if it is in part in those bank accounts, still the income requires to be computed and tax is paid on such income. But whether therefore whether he makes a disclosure of these bank accounts or not, that income is irrespectively to be taxed or not to be taxed in his computation for the assessment is 1718. So to tell you, I am also a little confused that what is the impact of not making any disclosure. The small study that I have done is that there could not be any such impact. As the return also cannot be treated as a defective return. And if at all the notices are issued to that person, I would not understand how would the notices also be issued, treating it as a defective return. How would the CPC understand that an SSE has an account but he has not disclosed in the return of income in the particular field? It's here the question is not of disclosure of the income. Here the question is only of the disclosure of an account, which is not otherwise supposed to be disclosed, I understand, except for because of this field which has been inserted now without having any support to the rules or support of the notification. Now, therefore, this is definitely going to be an area of concern of all the non-residents and the professionals who are filing the return of a non-resident. To conclude, I would say that it doesn't appear that it can be treated as a defective return. It would still not be treated as a return which is incomplete return so far as the computation of the income is concerned. Therefore, I would understand that it would not be mandatory for a non-resident to give these details of the bank accounts which are held outside India. Whoever are there online, I would, if still they have a query on this particular issue, or if they have any suggestions, they are most welcome so that I can share by way of this webinar. Now, the other disclosure is, which we have already touched upon, that is the disclosure of cash deposited during demonetized accounts, and which says that details of cash deposited in bank during the period this 9/11 to 30 December, if aggregate cash deposits during the year exceed or are more than 2 lakh of rupees. This also, if a person has already filed the return prior to 27th of April, which would be either a very few cases, still if the person has already filed, this insertion or the sigma is also by way of sigma amendment made on 27th of April. So if your person has already filed, I don't see any reason that he needs to revise his return of income to make this disclosure. The second one is detailed declaration of value of assets. We had an earlier also, I would say, Schedule AL, wherein this 50 lakh rupees, if a person whose income is more than 50 lakh rupees, then he was supposed to declare certain assets and the cost also of those assets. They have included some more fields for the declaration of immovable properties and for a person who have an interest in the assets also of a firm. As far as the immovable properties goes, address of each immovable property held has to be given along with the description. So I understand the description would be that it's a flat or a godown or a shop or a mall, etc. And as far as the address goes, yes, we need to give the address so that the identification of that immovable property is there. Thereafter, a second disclosure, what requires is the interest held in assets of a firm or an AOP as a partner. That is name of the firm, address of the firm, and PAN of the firm there was a query which says that what should be the value that they are asking for. Is it the cost, that is the face value, what the interest he has, or whether the market value of that, all the assets of that firm and the proportionate interest is to be given. It's only the, I would say, a capital invested on the date of balance sheet that requires to be given over here, and not the market value of the interest in the assets of the firm. By way of an instructions, we already had a question that how do we determine the various value of the assets, because either the assets cost is not readily available, be it jewelry, be it an immovable property, if it is acquired in the course of various years, if it is acquired by way of a gift, by way of bill, etc. To that they have issued the instructions in the ITR forms, and those specific instructions says related to cost of assets. In case the amount in respect of assets to be reported will be the cost price of such asset to the SSC, or where wealth tax return was filed by the SSC and the asset was forming part of the wealth tax return, the value of such assets as per the latest wealth tax return in which the asset was disclosed, as increased by the cost of improvement incurred after such date. And in case where the asset became the property of the SSC by way of a gift or a will or any specified mode under section 49(1), in that case the cost of the asset to be reported will be the cost for which the previous owner of the asset acquired it, as increased by the cost of improvement of the asset incurred by the previous owner or the SSC, as the case may be, or in case where the cost at which the asset was acquired by the previous owner is not ascertainable and no wealth tax return was filed in respect of such asset, the value may be estimated at the circle rate or the bullion rate, as the case may be, on the date of acquisition of the SSC, as increased by the cost of improvement, if any, or as on 31st March 2017. So to that extent, I think our major problem is solved, because it talks about how you can value those assets if you have never filed the wealth tax return or if the cost is not available with the SSC. The issue in small cases like LIC and etc. would still arise, that how do we give the cost, because the contributions by way of a premium are made by the spouse, by the parent, etc. and the cost of those policies are not available. In that case, except for those cases, more or less the issues are solved by way of these instructions. Now, the another disclosure which talks about is disclosure with regards to income computation and disclosure standards. That is, we all talk about is ICDS, that is which we require to report in ITR 3, 5 and 6. And now when we come to before a small query, a small query which is posed to me is that ITR of the income disclosure whether will be applicable to an SSC who is otherwise covered under, whose turnover is less than 44 AD, but because whose turnover is say less than 2 crore of rupees, a businessman is that turnover is less than 2 crore of rupees, and who has not offered 8%, in that case he will be not covered in ITR 4 by way of ITR 4. He will be filing the return in ITR 3 or ITR 5 depending upon his status. If he is a partnership firm, it will be ITR 5. In that case, ICDS provision would be applicable to him, because when we see the applicability of ICDS, it is not applicable to an SSC who is not covered under 44 AB. But a person whose income, whose turnover is less than 2 crore, but if is not who's not offering 8% profit, in that case is covered by 44AB. Therefore, the ICDS will be applicable to. So the ICDS, when we come to ICDS applicability, we'll see who all are applicable. Now, before that, in ITR, in Part A, where the disclosure of ICDS is required to be done, which says in ITR Part A, other information where we have effect on the profit because of deviation, if any, as per ICDS notified under 145(2), has to be given, which is linked to schedule of ICDS. Here, the amount is linked to the schedule of ICDS, wherein effect of each ICDS, that is a summary of the effect of each ICDS, is to be reported. Now, coming to the applicability of ICDS to all SFCs, other than individual and HUF who is not required to get his accounts audited under Section 44AB. SSC following mercantile system of accounting. Therefore, the person following cash system of accounting, we professionals are out of ICDS. SSC computing taxable income under the following heads of income, that is profits and gains of profession, yes, we understand, and even a person who is having an income from other sources, the provisions of ICDS will be applicable, and not for the purpose of maintenance of books of account. The ICDSs are not for the purpose of maintenance of books of accounts. The computation adjustments needs to be done outside the books of accounts, that is in our computation. And in case of conflict between ICDS and the Act, the provisions of the Income Tax Act shall prevail. Now, the list of notified ICDSs are there, available on the presentation. In the presentation, one is requested to just run through these provisions and what are the clauses that are to be reported in 3CD, and then we will run to for the ITR also. So in 3CD clause 13, they have inserted 3 clauses related to ICDS. This is one particular clause which says about each ICDS, increase in profit, decrease in profit, and the net effect of that has to be given in the form 3CD. And again in form 3CD, there is another clause, that is clause 13 only, which talks about the disclosure as per ICDS, for each ICDS, what disclosures are required to be done, and that has to be mentioned over here. Okay. Now, when we come to the return of income, there is no provision for the disclosure of ICDS. In the return of income, only the effect of the changes of ICDS is to be given. And that is also in the computation, you don't have a link. So you need to compute the net effect of the ICDS and mention in the return of income. So therefore, number one, no disclosure in the ICD or in the return of income is to be given. Only the changes, if at all there are, only that is to be given. Now, this is another input. Before we come to the specific questions, this is another important thing which we need to take care of. While processing the return of income, permissible adjustments are allowed. Now, this permissible adjustment talks about that. Sorry, there is some. Just bring this. I'll just. Okay. Here, these permissible adjustments which are allowed, friends, one needs to be very careful because this will be automatically done by the system from CPC. The first two we are all aware, arithmetical error and incorrect claim apparent from the information in the return, which was there earlier. Now they have added 4 more natures of these adjustments, which talks about disallowance of loss where return of the year of loss is filed late. That's pretty fine, we all are aware. So one need not take any such losses set off if the return of income was filed late in the earlier years. Second one is disallowance of expenses indicated in audit report but not disallowed in computation. Here one needs to be careful that in case if any expenses have been disallowed in the tax audit report and the same has been already uploaded, but that particular expense has not been disallowed under that particular section or that particular field. Say for example, if any expense has been disallowed under section 40A1A or 10,000 rupees, the audit report mentions disallowance of under section 40A1A. While preparing the computation and filling the return of income, that 10,000 has been taken care of, but it has been disallowed under wrong section, say section 37. Section 37 and 40A1A, I understand that they will try to match it and these adjustments will be called for. So one needs to be careful while filling up the return of income that a particular expense which is there under a particular section for audit report, only under that only corresponding disallowance is disclosed and made in the return of income also. That is one care that one needs to take. But however, the dispute will arise wherein the audit report says an amount of disclosure of 14A, say for example 14A, would be X, but the SSC or even in the audit report it has been very clearly mentioned. However, because of various judicial decisions which are readily available right now or various pronouncements which are carried out by way of ITT orders, the SSC is of the view that no disallowance is to be made. In that case, there would be a difference of views. But however, as far as 143(1)A adjustments are concerned and what the wording talks about is disallowance of expenses indicated in audit report. So it is indicated in audit report but not disallowed in computation. Therefore, if an auditor writes down that without that no disallowance is made, of the that no disallowance should be made. However, if at all the provisions of 14A are applied, then the amount would be X. So it is indicated, but no disallowance is made. So therefore, in such cases, when the audit report is uploaded, one needs to make an appropriate disclosure. Secondly, disallowance of deductions under section 10AA, ATIA, ATIB, etc. If the return is delayed, that the provision itself says that those deductions will not be allowed. Therefore, if the return is delayed, one needs to see to it that the deductions will not be allowed. But what about in cases if there is a genuine reason it was prevented by a reasonable cause? Then that would be a case of a dispute one needs to fight before the appellate stage. The third one is also, fourth one is also very important. Addition of income appearing in Form 26AS or Form 16A or Form 16, which has not been included in computing total income. The 26AS is not in the control of the SSC. It is generated by the traces. which is again an income tax. And we all know how it is generated. It is the information that the deductor gives to the traces by way of the TDS statements. In case if there is any mistake by the deductor, then would that be an income of an SSE? The answer to that is no. That needs to be rectified. If he has not rectified, then that cannot become an income of an SSE. An income of an SSE of that year. So in a case of cash system and dispute between a cash system and an accrual system, we all know that yes, the income is to be SSE who is following cash system of accounting. He will be accruing his income also on the receipt basis. Though the 26AS will show that the tax has been deducted, but since the SSE has not received in the relevant year, he would be offering in the year only in the year in which he has received. To that extent also there will be a mismatch, not only qua the TDS claim but also qua the income. So this one needs to be careful, so that before filing the return of income, one should go through the 26AS. I understand this 26AS goes on updating every time. Whenever the deductor files the correction statement, the 26AS gets updated. But before all these adjustments can be carried out under 143(1), a notice will be given and a response will made by the SSE will be considered before carrying out this adjustment. And if response is not received within 30 days from the issue of notice, issue of intimation, then the adjustments will be carried out. And mind you friends, the response you are supposed to give online, the notice also will be served online. Not necessarily it will be served in a physical form. It will be sent to your email account. So every day morning, you need to see that whether the SSE, if by any chance you have given your email ID, then you need to verify whether you have received the notice. Otherwise, the email ID which is available on to the department, the latest email ID which is available to the department or as per the return of income file, the notice will be served on that email account, and that email account needs to be verified. And by any chance, if the notice is received, not responded within 30 days, in that case, the adjustments will be carried out. The issue will come up that whether one can file or appeal against that adjustment. Answer to that is yes, the scope is available. Is this appeal filed? Is it a mistake apparent from record? The answer to that would be depending upon the facts of the case, whether it's a mistake apparent from record or whether it is a matter itself that requires to be argued independent of it. So friends, now let us run through in the last 10 minutes, there are certain questions. We will, before we started with also there were certain questions. So let me first take up the questions which I have not dealt during my talk. One is the bank account outside India, non-resident, that I have already discussed. The disclosure as far as the demonetized amount also has been discussed. Yeah, the foreign bank accounts have also been discussed. Now coming to in the question raised, in a case an SSE opting for section 44 ADA and also having capital gain, then he has to file the return of ITR 3. But in ITR 3, gross receipts column not available. What to be done? If a person is opting for 44 ADA, then it's a presumptive tax that he's been opting for. And in the case of presumptive tax, let me first of all accept and confess that yes, I do not have a practical idea of the procedural part, but let me try and answer this question that ITR 4 will be applicable. Looking at my slide 40, that ITR 4, which talks about presumptive income from business income. So it's not that ITR 3 will be applicable to that person. The person will be, since it is covered in 44 ADA, which is a presumptive income, and therefore ITR 4 will be applicable and not 3. The second question, is it mandatory for an NRI to disclose all foreign bank accounts? What is the penalty? I have discussed that. SSC, next one, SSC having professional receipts 33 lakhs and his net profit is 1 lakh and other income 90,000, total income 1.9 lakhs, which is below basic exemption limit and therefore not required to go for tax audit. Whether he has to opt 44 ADA, reason is from this year only ADA is introduced. If he opts for 44 ADA, then also his profit will be below exemption limit and AO will not question further. I certainly agree with this. Yes, he can offer for 44 ADA and he does not have to get his accounts audited because he is an individual. I understand, though it is not clarified over here in the question, but I clarify and I understand he is an individual. Therefore, it is that his income is not under the, his income is below the exemption limit of 2.5. Updated income tax returns are asking for details of bank accounts held outside India by non-resident. What is the purpose? Yeah, dealt with regarding the non-resident bank accounts. There are major queries. I understand, but I have also dealt with this question. Does a company not being in the business of car dealing have to collect TCS on sale of a car which is a capital asset of a company's books? If it's a capital asset of the company's book, he does not have to collect TCS. This is the readily answer that I can gather. I may be corrected if after seeing the provisions of 206, I will have to check it. By any chance, if the act is available, just let me have a glance if we have time. Before that, let me take up another question. In case of SSC opting for section 44 ADA and also having capital gain, then he has to file the ITR 3, but that I have already dealt with. One question related to slide number 11. What is the period of holding for slide number 11? Sorry. Slide number 11. Okay, that is about the period of holding for short term or a long term. What is the period of holding for listed debenture bonds for it to become a long term? Listed shares we do not have anywhere listed debentures or bonds. So what unless it's a zero coupon bonds, it is 12 months. Otherwise, I think it should be 36 months. It will fall in 36 months. The person who has asked me this query, I will answer him offline if there is any change in this answer. And the question I did not answer is about the TCS. Let me have refer to this TCS provision. They have seen this section so many times. I'm sorry, friend. I readily, since it is not available with me, I need to just go through those relevant provision. It is 206. Yeah, friends, I think barring for this, I have tried to take up all the questions, and once again, I thank the organizers for giving me an opportunity to run through these changes and the amendments. Thank you once again. Thanks a lot.
Yeah. चालू है? Friends, we all agree that Mahindra Bhai has explained us the provisions in detail and very thoroughly. So, on behalf of Chambers, we would like to thank Mahindra Bhai for giving his valuable time today and sharing his knowledge with us. Thank you.